Welcome to Investors Guide. You're watching ET Now. I'm Faye D'Souza. If you have any question at all about your money, whether you're saving for your child, you're planning for your own future, or you just want to spend your money going overseas, write to us on the email ID that's at the bottom of your screen, and we'll help you make the most out of every decision you make when it comes to your money. Remember, at the end of this year, we have a really special two-part series which will help you plan out your money. And we've got some amazing guests in the studio. Kumar, of course, who spends time with us. Ramdev Agarwal and now Rashesh Shah has also agreed to be part of this show. They're all going to be in the studio right here. And we'll bring in an audience of investors. So if you'd like to be part of that audience, write to us on the same email ID or reach me on Twitter. And we'll have you come in and you can ask them your questions yourself. This week, though, on the show, we'll help entrepreneurs invest for their employees and plan for their futures. In our product review this week, we look at the L&T Equity Fund. And Andrew Holland joins us in the studio to talk about the stock market and opportunities for retail investors like you and me. It's time for me to bring in Kumar. Remember, Dhirendra is our mutual fund expert. He's been helping us with these investments now for the last 6 years. Dhirendra, thank you so much for joining us on Investors Guide. It's a pleasure to have you. Let's get straight to our portfolio question. Well, Jyotirab Chatterjee has written in from Noida, Dhirendra. He's 37 years old. He works in an IT company. His wife works for the central government. They have a combined monthly take-home of 1.23 lakh rupees. Now, he's invested in infrastructure bonds. He has fixed deposits and he has the PPF over and above his salary, which will obviously include a PF as well. They have a health insurance plan. Now, here's an interesting goal. He wants to create a corpus of 80 lakh rupees to buy a home in the NCR after 6 to 8 years. And he wants us to help him create that corpus. And obviously, you'd know better than anybody else, Dhirendra, you live in the NCR, that it costs a lot of money to buy a home there right now. But if you look at his mutual funds right now, I think he has won too many mutual funds. Would you like him to sort of streamline his portfolio? I'm not happy with the allocation. There's so much money going into the PF and into other debt-based investments. And he has won too many mutual funds, in my opinion. What would you like him to do?
The one is that, the SIPs which he's doing, in 6 funds, that is where he should consolidate all his money. In fact, he can even knock the balance fund out of it because I see that, the next 5 to 7 years, he should be as much into equity. And, if you look at his allocation, it is very much tilted towards fixed income. Though his SIP is going into these equity fund and he has accumulated about 10 lakh rupees worth of equity funds. And they look like a random, collection or selection of funds. But he has nearly 27 lakh rupees accumulated in his PF and PPF as well as his fixed deposits. So he should, earmark that money, try and scale it down. Move gradually to equity because, one is to accumulate money to buy his home and the other is, planning for his retirement. And for that, that goal is still quite some time away. So that should be as much into equity and he should, put some kind of, he should state some asset allocation that what part of his money should be into fixed income and stick to that. Without setting that goal of, following an allocation model, he will just be thinking that, he'll be conservative and his money will not be fully at work.
All right. So like we always say on this show, in fact, you should just repeat it with me. You have to start your emergency fund. You have to have health insurance. You have to have life insurance, a critical illness plan if you want to. Once you have all of these things out of the way, like Dhirendra says, if you have a long-term horizon, 6, 10 years, maybe longer than that, and your retirement is something you should consider as well, put a lot of your money into equity. Dhirendra is saying hold on to the 4 funds on the top of your list that you're using right now, the 5 funds. Those are the ones you should be focusing on. Consolidate all of your investments into those funds. Dhirendra, I've noticed that he has a couple of tax gain or tax saver funds in his portfolio as well. Since he doesn't have a home loan right now, he might need that tax saving, both from the PPF and from his tax saving mutual funds. What would you recommend he does to supplement that need?
No, I think, he should certainly continue his PPF because he has accumulated his savings, but just invest the essential amount to keep your PPF account live. And rest of all his money, he should avail the ATC. There's a possibility, given his income scale, there is a possibility that he just might be, availing the whole ATC with his a good part of it from his EPF contribution. So beyond that, if he's still left with something, then he should invest in the tax saving fund. That should be the first gateway investment for any investor. That should be the first equity investment if you have time on your side, at least particularly if you have 10 years and more.
All right, on your screen right now are tax saver funds that Dhirendra recommends on this show. There are aggressive funds and there are slightly more conservative funds. And considering you seem like an aggressive investor, maybe the aggressive funds would suit your needs better. If you have any more questions, of course, you can get in touch with us. Then the very interesting question this week, M.S. Nagesh has written in. He tells us he runs a small manufacturing unit with an annual turnover of 5 crore rupees. He has over 30 employees between the ages of 20 to 30 years. Now, he would like to do something for their future. So he wants to put aside either 4,000 or 5,000 rupees every month for employees who've completed 5 years of employment in his organization, which is such a wonderful thought. He wants to invest this money in equity, he says, for now, and then convert it into fixed income so that they can derive pensions from this money. How should he go about it? So there are a couple of things to consider. One is the fact that if he wants to invest this money on behalf of his employees, it will either be considered part of their income or as a gift. They will have to pay tax on it, and he cannot necessarily prevent them from pulling that money out. As an entrepreneur yourself who runs an office with young people working for you, you possibly can identify with what Nagesh is thinking of. What's your recommendation? What is the best way for him to go about doing this?
The best way of approaching it will be helping his employees open an NPS account, hand-holding them to get into the highest equity plan, and this way it will be scalable. And if he adds too many people, it will still be replicable without much of an effort, and it will be legally perfect.
All right, so there you have it. That's a perfect solution. The NPS there will also allow you a portion into equity. So whatever you want to make sure your employees invest in equity, you can make sure that happens as well. And like Dhirendra said, it's tax deductible for you. And if your employees contribute on their own, it's tax deductible for them as well. Welcome back. You're watching Investor's Guide on ET now. Thank you for staying with us. It's time for our product review. Remember, we review one fund on the show every week. This week, we're looking at the L&T Equity Fund. Avan will give you a quick introduction and then we'll come back and talk about it. Avan.
Thanks, Faye. This week, we talk about the L&T Equity Fund, formerly known as the Fidelity Equity Fund. Now, many large-cap funds adopt a concentrated strategy to outperform the index, whereas the L&T Equity Fund prefers the other extreme. It owns a large amount of stocks in its portfolio, with a current stock count of 53 compared to the category average of 43 stocks. The stock count is still lower compared to the count when it was held under Fidelity. The fund has a sizable mid-cap allocation compared to its peers. The large-cap funds hold over 90% of their assets in blue chip. This fund holds 65 to 70% in large caps, while the rest of the allocation goes into mid or small cap funds. The mid cap allocation has risen in the last 1 year, providing a kick to the returns. Due to the rise last year, the fund's return beat the benchmark and the category by nearly 10%. The long-term returns appear middling, but the recent improvement offers promise over the long term. Despite the acquisition and its recent performance, should you be invested in this fund? Our experts are here to give you the answer. With that, it's back to you, Faye.
All right, Avan, thank you for that introduction. Dhirendra, if we look at the returns that L&T Equity has given over the last year or so, it has been impressive. Would you say that it continues to be on your list of funds that we could all just add to our portfolios at this point?
Yes, it has provided all these returns and marginally superior return to its category, as well as it's beaten its benchmark by a modest margin. And yes, I would say that this fund has actually moderated on the risk front. It has become a little more stable relative to other funds in this category. It is not as volatile, and that is what is the plus. Also, its large cap tilt has gone up. It did undergo a change of category not very long back. So yes, it is an excellent fund. It has continued the good work, and it will. This fund, the way it is, the way I look at the portfolio, it has never been a blockbuster. But on a slightly longer time frame, this fund looks very impressive.
Dhirendra, the last time we talked about this fund, you gave it 4 stars on Investor's Guide. What rating would you give it this week?
I would once again assign it a 4-star because there are a few other superior alternatives to this large cap fund. But yes, this is also an excellent choice. I'll give it a 4-star.
4 stars there for the L&T Equity Fund on Investors Guide. If you have questions about that fund in particular, you can always write to us. Email ID is right on your screen, right there. Let's move on to our hold or sell segment. This week we have CSS Mukherjee, who's written in Dhirendra. He's 60 years old. He has not one, not two. He has 14 funds in his portfolio and he's putting aside 19,000 rupees every month. He wants to know if he should make changes in his portfolio. I am not going to read out a list of 14 funds because I can tell you straight off the bat right now, Mr. Mukherjee, that you have one too many funds in your portfolio, especially given your age and the fact that all of these funds will require that much more management and tracking. Dhirendra, for someone like him, and he has a fairly comprehensive list of funds in his portfolio, so which means that he does want to be exposed to equity. What would you recommend he does? How can he consolidate this entire list of 14 funds and bring it down to a manageable 4 or 5 funds?
I would like to congratulate Mr. Mukherjee in terms of, he has added many, but I understand his dilemma. His selection of fund is outstanding. If I have to choose funds from varied category, most of these funds will be my selection too. But for sake of convenience and also for sake of achieving his goal that he should attain, he should gain diversity. He should have adequate diversification. If I have to choose the funds, which will actually qualify like a fund which will give you exposure to the full market exposure, I would say ICICI Dynamic Fund or Quantum Long-Term Equity Fund. They are these funds are not deprived of your small cap exposure. The other ones which you have chosen, BNP Equity, for example, or Axis Equity Fund, I think these 4 funds will get you full market exposure. On a 5-year basis, I don't think you'll be disappointed or you'll be deprived of any opportunity in the market.
So there you have it. That's the advice you're getting right now. And if you have questions about making that shift from an aggressive investor to a retired investor, you can write to us. Our email ID is at the bottom of your screen as well. Dhirendra, thank you so much for spending time with us this week and answering all of our questions. Welcome back. You're watching Investors Guide on ET Now. Thank you so much for staying with us. I have a special treat for you this week. Andrew Holland is the CEO of Ambit Advisors. He's come into the studio this week to talk about the markets and to talk about opportunities for retail investors like you and me. Andrew, it's such a pleasure to have you here.
Thank you for having me.
I'm going to ask you the obvious question. There's a lot of talk right now about the fact that we're in a long-term bull run. Some of the projections are almost embarrassing. There we are talking about, 1 lakh on the Sensex in the next 4 or 5 years. Tell me where you stand in terms of where you see this market going and in how long.
So we kind of think over the next 2 to 3 years, given the earnings growth. And India's a domestic growth story. There's nothing more to it than that. And we look back and thought about between 2003 and 2007. It's really an IT-led GDP growth which helped India propel earnings then. This time around we think it's going to be pure domestic demand and growth in infrastructure which is going to propel the index further forward. So earnings we can see growing at 20–25% over the next 2 to 3 years. So if I just fast forward, I can see an index of of the Sensex of around 45 to 50,000 over the next 2 years or so.
Obviously, the next 2–3 years that you talked about, before we see 50,000 on the Sensex, is not going to be a smooth one-way ride.
No.
It will be bumpy. Tell us what to expect as investors, because a lot of times retail investors tend to get in sort of at the end of the wave.
Yes.
Tell us what to expect, and tell us, according to you, what is the best way to approach a market like this one?
So first of all, I don't think we're at the end of the road at the moment. But you're right. I mean, even if you look between 2003 and 2007, every single year you had 1 month where the market would fall between 15 to 20% for whatever reason, global reasons, local reasons. But, for retail investors, just investing on a regular basis over time, you're not trying to time the market. And I think what we all try and do is try and find the bottom or sell at the top. I think if we have a longer term horizon, stick with the good companies, and try and continue to invest on a regular basis rather than just one lump sum, and then markets might go down in the short term and get nervous about that.
All right, so I'm going to ask you this. Assume I'm a young 30-year-old. I won't tell you how old I really am, but assume I'm a young person who walks into your office today and says, Andrew, this is how much money I have. Split it up for me, equity, debt, whatever else you'd like to allocate my money to. Obviously, I'm assuming gold is off the table at this point.
Yes.
But tell me how, for a 30-year-old watching at home right now, what is the ideal asset allocation you would give? So if I give you 100 rupees, simply how would you split it up?
Yeah. Well, assuming that you obviously have all your insurance policies and that's sorted out, then I would be saying that you probably need to have more in equities, probably 70 to 80% in equities, given our view on equities. In the shorter term, you could have a little bit more in debt because we do expect interest rates to fall very sharply over the next 2 years, at least up to 300 basis points. So you can make money both on debt and equity over the next 2 years. But I think for your longer term planning, then equities is where you should be more geared in terms of, that's why I'm saying 70, 80% rather than a higher portion in debt.
I'll come back to debt and interest rates in a bit, but I want to talk to you about your core opportunities PMS product right now. And I was reading through it, and it says that you're going to focus on the mega domestic supply theme.
Yes.
Tell us what the mega domestic supply theme is.
It's very simple, actually. It's a bit like Prime Minister Modi saying made in India. Now, if you make in India, then something has to be supplied to make in India. So we think that in the next 3 years, when we look back with hindsight, and when I'm here in 3 years' time, what would the theme that would have played out over that period? And we think it's who supplied India will be where you would have made, the companies would have, profitability would have increased significantly because you get operational gearing as well playing in, and where the share prices are currently not reflecting that huge upturn in earnings as orders start to be given or as services play out in terms of providing a service or a product.
Right, I have two questions for you, and I'm going to ask you the obvious one first. In 2007 and 2008, there was the infrastructure boom, and
Yes.
a lot of investors got in on the infrastructure boom, either through funds or directly through the stocks. That, fizzled out very quickly, and a lot of us didn't recover our money. How do we know when we focus on a specific theme like this one, that when the music stops, I'm not going to be the one left holding the parcel that's not worth much? How would you, what is the risk of doing something like focusing on a theme, and how would you guard me against that risk?
So in 2013, for example, whilst it was a very difficult market, if you would have had sectors such as consumer stocks, IT and pharmaceuticals, you would have made a lot of money in 2013. So what we try to say is that whilst it's a mega supply theme, it's across all sectors and across all cycles of the economy and of the market.
Again, let's go back to the basic investor. At what point do I come to a PMS service like this one? After I've put aside all of my long-term money in mutual funds, I've got the allocation that you said, what portion of that allocation then should I focus on, say, a core 15 stock, high conviction portfolio like yours?
You see, if you believe in the theme of supplying India, which we do, then it's going to be captured by a small number of stocks, which we have picked out as saying we think they're the best within the sector. For whatever reason, it could be management, it could be product, it could be pricing power, it could be numerous things. It could be ratios in terms of the PE ratios or price to book. Many, many factors go in there. But, if you're buying, say, a mutual fund, you're buying a larger theme.
Yes.
With probably 40, 50, even more stocks. So we believe by buying a concentrated portfolio, you can benefit from the growth in India and the supply theme that we think is going to play out.
All right, so Andrew, I know how to buy a mutual fund. It's fairly obvious. I call either a distributor or an agent. I know what the charges or the fee structure is of a mutual fund. Tell me how to access, if there's a viewer right now who thinks that, okay, this is a good idea of this PMS portfolio, how do they access it? What the charge or the fee structure is for a service like this?
Well, I mean, obviously they can go through their own advisory companies, which will then contact Ambit, or they could come direct to Ambit, and we could supply the forms and do the due diligence and so forth. Know your client, and the fee structure is quite unique within PMS. So we've got two structures. One is just a flat fee of 3% management fee per annum, or if you don't want to pay a management fee and you like to see performance first, we will only charge 20% performance fee over a hurdle rate of 12%.
Okay.
So it's an option for you because a lot of investors have had to pay management fees and not seen performance. you know, and it's galling when that happens for investors. Or, you know, it kind of
so
upsets
only
them.
if you make more than 12% for me, you're entitled to 20% of that.
Yes.
Okay. So tell me this: if we were to look at the core opportunities PMS right now, what are the risks of investing in that portfolio?
The risk is obviously we are in a concentrated portfolio of 15 stocks. One or two of those stocks might not work out to you know what we're expecting to happen over the next few years. But we have very strict risk controls as well in terms of sector exposure, single company exposure, and obviously we're reviewing our companies on a regular basis to make sure that you know the catalysts that we're looking for are starting to be met. And obviously, if it's not going to happen or something changes for the company, then we're quite happy to switch that company and move the investment into something else.
Many thanks for joining us on Investor's Guide. It's been an absolute pleasure. Of course, if you have questions for Andrew about the core opportunities portfolio that you heard on the show, write to us. Our email ID is at the bottom of your screen, and we'll have Andrew answer those questions for you. Thank you so much for watching Investor's Guide. Get in touch on Twitter if you have a question for me. Thanks for watching.